Hi traders, you're welcome back to the Forex Geek channel. Do you want to make sense of price trends and spot potential trade setups more easily? Moving averages are actually one of the simplest yet most powerful tools in Forex trading. Now, whether you are a beginner or looking to refine your strategy, this video is going to break down everything you need to know about moving averages, how they work, how to use them, and how to avoid common mistakes. Now, before we get started, hit that like button, subscribe to the channel, and turn on notifications so you don't miss any future trading content. All right. Now, a moving average is a technical indicator that smooths out price data over a specific period, helping traders identify the overall trend. Now, instead of focusing on short-term price fluctuations, moving averages give you a clearer picture of where the market is heading. You will notice that when you observe the chart, you're going to see that the moving average usually gives you the direction of the trend by moving in that direction of the trend. Okay? So why do you use moving averages, or why do you need moving averages? One is that they help you filter out market noise. Secondly, they identify trends and trend reversals. Thirdly, they act as dynamic support and resistance levels. So there are different types of moving averages, and knowing which one to use can make a big difference in your trading. Okay, there are two main types of moving averages that traders use. The first is the simple moving average. All right, I'm just going to change this to the SMA for the purpose of this explanation. You can see I just changed the MA method to simple. So this is the simple moving average. Now the SMA calculates the average price over a set number of periods. Remember, whenever I mention set number of periods, I'm referring to the value within this box. And what this value represents is the number of candlesticks in that time frame, right? For example, if we are on the 1 hour time frame, let me use the 1 hour because it's going to be easy to explain. If we're on the 1 hour time frame, and you can see here we have 50 periods, it means 51 hour candlesticks. That is 50 hours. So it means the calculation is done over 50 hours. If we are on the daily time frame, it means it's done over 50 days. All right. So the period is done. The period is calculated based on the number of candlesticks. So if you have 50 periods, it means 50 candlesticks for that time frame. If you have 20 periods, it means 20 candlesticks for that time frame. Okay, so the SMA calculates the average price over a set number of periods. You're the one to determine the number of periods because you're the one that is going to set the value that you want inside this box. You can decide to set it according to your trading style. Okay, now the SMA gives equal weights to all data points, and it works best in stable market conditions. Now, the second most popular type of moving average is the exponential moving average. The EMA gives more weight to recent price data. It reacts faster to price changes, making it more suitable for short-term trading. Okay? Now, if you are looking for a long-term trend indicator, the SMA is actually a great choice. But if you need something more responsive for short-term trading, then the EMA is your best bet. All right? Now, moving averages are one of the easiest ways to spot trends. Here's how. In an uptrend, if price is moving above the moving average and the moving average is sloping upwards, like what we can see here, the market is in an uptrend. It means that the market is in an uptrend. On the other hand, if price is moving below the moving average and the moving average is sloping downwards, the market is in a downtrend. It's as easy as that, very easy to spot. Then finally, if the moving average is flat, let's look for a good example. Okay, we can use this. If the moving average is flat and the price is moving back and forth around it, up, down, up, down, up, down, up, down, it means that the market is ranging. Okay, so using moving averages as trend indicators helps traders to stay on the right side of the market. So basically, if price is trading above the moving average consistently, you should be looking for buy opportunities. If price is trading below the moving average consistently, you should be looking for sell opportunities. Okay. Now, one of the most popular ways to use moving averages is with crossovers. This happens when a short-term moving average crosses above or below a long-term moving average, signaling a potential trend change. Now, for a bullish crossover, okay, I'm just going to be modifying this to the 50 EMA, and I'm going to change the color. All right, and I'm also going to add the 200 EMA, and I'm going to change the color. All right, now a bullish crossover, also called a golden cross, it happens when a short-term moving average, for example the 50 EMA, crosses above a long-term moving average, for example the 200 EMA. It signals a potential uptrend. You can see what happened after the crossover. On the other hand, a bearish crossover, also known as a death cross, a bearish crossover, also known as a death cross, it occurs when the short-term moving average, which is the 50 EMA in this case, crosses below the long-term moving average, which is the 200 EMA in this case. It signals a potential downtrend. All right. Now, crossovers work best in trending markets, but can give false signals in choppy conditions. So always combine them with other confirmations. Okay, it is very, very important. Now, another powerful way to use moving averages is as dynamic support and resistance levels. In an uptrend, price often bounces off moving averages like the 50 EMA or the 200 period or the 200-day moving average, okay, acting as a support. In a downtrend, moving averages act as resistance. All right, let's just look for a good downtrend. Okay, see this? In a downtrend, moving averages act as, resistance. You can see dynamic resistance, preventing price from breaking higher. Many traders use moving averages to set stop loss levels or plan the entry points into strong trends. For example, if you're in a strong trend, you can be entering more trades in the direction of the trend whenever the price gets to the moving average and starts reversing, or rather, and starts continuing back in the direction of the trend. Okay. Now, a lot of traders make mistakes when using moving averages. So here's what you need to avoid. First is using the wrong time frames. Shorter moving averages are too choppy for long-term trades. So make sure you use the proper time frame, okay? Also, longer moving averages react too slowly for short-term trades. So you have to create a balanced scenario. If you're a long-term trader, you should use higher time frames for longer-term moving averages, or rather for higher days moving averages. Then another mistake is ignoring market conditions. Moving averages work best in trending markets, but can give false signals in ranging markets. Okay. Also, do not over rely on crossovers. Okay, because crossovers are useful, but should not be the only reason for entering a trade. All right. Do not forget confirmation signals. Okay, that's the reason why it's always good to use other indicators like the RSI, MACD, or support and resistance zones, your horizontal support and resistance zones, okay, for stronger confirmations. All right, it's very necessary. By avoiding these mistakes, you will improve your use of moving averages in trading. So that is your beginner's guide to moving averages. Now you know how they work, how to use them, and how to avoid common mistakes. All right, if you found this video helpful, hit that like button and subscribe for more Forex trading strategies. Also, drop a comment below and let me know what is your favorite moving average setting. All right, let us talk in the comment section. In the meantime, thank you for watching, and I hope to see you in the next video.